Let's bring in KKM Financial CEO and CNBC contributor Jeff Kilberg and John Augustine, the CIO at Huntington Private Bank. He's here on set with me. Welcome to you both. John, I'll just start with you. And it's kind of a weird thing where whatever you think of the direction of tariff policy, and the way that I see it, I see more analysts kind of warming up to the idea that that might be a useful tool for the U.S. in the long run. But in the very short run, markets seem to still want nothing to do with it.
Right. And today obviously fits into that mold of it's going to be confusing. It's probably going to be confusing, implemented second half of the year, probably affect 2026 more than 2025. Usually, what we would think of is it would be positive for small and mid caps. We haven't seen that happen yet. So confusion's kind of in the air right now. But as you said, it's one of those policies that's going to impact markets.
Was it positive for small and mid caps last time, or was it, they were relatively small last time as well?
It was initially, yes.
Yeah.
We didn't have those chip stocks last time.
Right. So
or the Mag 7s.
In what way does that change things now?
It probably keeps money away from small caps more as there's more competition. We view there being more competition in small and mid cap stocks right now, is how we view it. And that's what's impacting them. Private equity, Bitcoin, et cetera. There's more competition in that space than there used to be.
So where does that leave you? I mean, like, what do you think is kind of the default strategy for the year while all of this plays out? So
you play cash flow in large caps. But this year may bring a sense of income. The concept of income is back. That's what may help smooth some volatility this year. That's what we're looking at. So the 4% is the number we're kind of looking at.
But 4% is not that great.
And at the 2% plus inflation rate, it's okay.
But post-tax, I mean, as people kind of look through it, they go, so what did I really pocket from this?
We're not talking about long-term themes. We're just talking about addressing volatility this year.
All right, fair enough. Jeff, I mean, you look at volatility and this kind of stuff all the time. As we have to wait, look, it's possible. And the advisors who were mentioned in this Washington Post piece include Scott Bessent, the incoming Treasury Secretary. So the president may be denying it, but it seems obvious to me that there are some in his circle who are trying to kind of move forward with this idea of things being less universal than he campaigned on. And they said one of the reasons that he might consider a slight change on this front is inflation. It's been stickier than expected at this point, and any tariffs are going to add at least some near-term price pressure.
I think that's right, Kelly, and it's interesting to see that tough talk that we've seen all campaign prior to President-elect Trump winning the campaign back in November. But since then, or since the insinuation that he was going to win, you saw the dollar index move higher because of those tariffs. You saw about an 8% jump in the U.S. dollar index. The VIX still sitting out at 16, and equities moving higher. There is, to John's point, a lot of uncertainty. But what I think today with the catalyst for this move higher, which seemingly is selling off just a titch here, but what the catalyst was that there's going to be less tariffs, and those tariffs come with unintended consequences. There's inflationary concern, but on the flip side, there's also potential more revenue for the Fed. There's manufacturing jobs that may be reshored. So all this uncertainty is probably not going to be unpacked on January 20th, let alone January 21st. But I think what you have to realize is that dollar index, the U.S. Treasury, look at the 10-year note, up at 4.6%. That's going to incite volatility. I think we're in a bit of a complacency. We're all focused on AI again. It's wonderful to see NVIDIA back above $150. But I think when you see the actual tariff policy be implemented and actually transact into the economy, that's where we're going to see some volatility. And I want to be hedged, and I like using a couple different ETFs, Kelly. If you look at DBEF, that's a way to be hedged. I think you also can look at the wisdom tree if you want to have a select exposure to some of this. But being hedged here with this currency risk, that's going to be a big theme, and no one's really talking about in Q1 right now.
So on that point, we were talking on Friday about the two kind of problems for the market right now, Jeff, being high dollar and high yields. Would you agree with that?
It is, and some people say if the 10-year note goes up to 5%, they'll be more attractive. But for all the folks who dumped in to the 10-year note 2 years ago at 5%, they were remorseful since the S&P 500 returned back-to-back years of nearly 25%. So I think the risk in the market, Kelly, is look at today. We saw a historic high. The top 10 holdings of the S&P 500 went up to 50% of the market cap of the S&P 500. The market cap of the S&P 500 is $46 trillion. We saw half that represented this morning in just 10 names. So this vulnerability of a revaluation, a reset, I think is coming. But I welcome that because then we have the ability to have a more broad rally. There's no depth in this current rally. We're just seeing the same AI theme, which you can't get short. That's disastrous to get short of. I've lost a little money buying puts on some of these names, but I do think there's going to be a bit of a revaluation here, Kelly.